In 2008, as the American financial system was in meltdown, there were fears that this would spread to the rest of the world. Everyone was looking to see how developed economies would cope with the financial shocks, but no one was expecting that the Eurozone would soon face a sovereign debt crisis.
People always say that you can't see crises coming. And that's true. They are very hard. It's certainly very hard to know when they will come. And almost nobody is ever able to predict any kind of remotely approaching precision exactly how a crisis will unfold.
Paul Blustein is a CG Senior Fellow and a journalist. He's studied the international financial system and the International Monetary Fund for decades.
The IMF, of course, is the world's financial firefighters. And the IMF was absolutely out to lunch on this. They did not see that the Eurozone was in any sort of trouble. All the focus at the IMF and really also in the G20, the major industrial economies, was on, well, what's happening in the US and what's happening to emerging markets. Even then, they didn't think that the Eurozone was where all the risks lay.
The recovery is here, that's clear, everybody understands this. It's even better than expected, and we forecast in the IMF global growth around 4% for 2010.
In late 2009, early 2010 was when the crisis really began to manifest itself, and Greece began to fall into a really serious debt problem. A lot of Europeans were saying, we don't want the IMF. The IMF is for Angola. The IMF is for sub-Saharan Africa. It's for Latin America. It's not for rich countries like us. And the IMF was very anxious to be involved in the crisis because they, if there's a big financial crisis, they really feel that they need to be in.
The IMF's managing director, Dominique Strauss-Kahn, and other senior IMF officials were working hard to convince EU leaders that the situation in Greece was not isolated to Greece.
What is at stake is certainly today the economic situation of Greece, but it's more than that. Because Greece is part of the Eurozone, because of the solidarity system of the Eurozone, every day which is lost is a day where the situation is going worse and worse, not only in Greece, but in the whole European Union, and it can also have consequences more far away.
The Eurozone economies and financial systems are strongly interconnected because they share a single currency, the euro. The European Union is composed of 28 countries, and 19 of those countries are part of the European Economic and Monetary Union. But the European Monetary Union is unlike other monetary unions in that it's composed of sovereign states. This is unlike, for example, the US dollar.
We have one currency, the US dollar, covers all 50 states. But if a bank in North Carolina gets into serious trouble, we don't put it all on the taxpayers of one state. But in Europe, that's the way it was working. The individual countries had responsibility not only for regulating, but also for bailing out their banks.
In most countries, the central bank acts as a lender of last resort to weak banks. And it also acts as an effective backstop to government debt because it controls the stock of the currency. In the European Economic and Monetary Union, however, sovereign states were left to support troubled banks, while the European Central Bank has a very strict mandate that prevents it from supporting troubled governments. This phenomenon created what is called the sovereign bank doom loop. Here's how it works. If the banks were weak, the sovereign state was left to provide funds to prevent a banking crisis. Given the size of modern banking systems, this caused sovereign debt in many countries to soar. Similarly, if sovereign debt was high, financial markets lost confidence in the stability of the national banking system. In these circumstances, banks looked weak, both because of the potential for economic crises that would see businesses and households default on the loans they have with the banks, and because banks held large portfolios of their sovereign government's debt, which was seen as having a higher risk of default. High sovereign debt therefore caused difficulty for banks to access funding, and weak banks cause countries to have to pay a premium to access debt markets.
In the US, again, the Federal Reserve, which can print money, is there, to back up the system, but you didn't have that for Europe in nearly the same way. And the IMF had been saying, you really need to do something to integrate your banking system more. So they were warning about this. And as the crisis unfolded, the IMF was really jumping up and down and saying, look, we got to do this because the Eurozone is going to blow apart because of this vicious cycle. So the IMF was way ahead of the curve on that, and you've got to give them credit. Now the problem is that the IMF couldn't make Europe do anything. When the IMF rescues a country, they can say, well, we'll lend you money, but only on the following conditions. They were helping to rescue the euro, but they couldn't tell Germany and France what to do because Germany and France said, well, you're not rescuing us. You're rescuing those weak countries out in the periphery of Europe. The IMF could only use its powers of persuasion. The fact that banking union eventually did get done, the Europeans did see the light, they did understand that they needed to do it. The European Central Bank was much more willing to use all of its powers to do whatever it takes, saying if any country gets into trouble the way Greece has or Ireland has, if that happens in the Eurozone anymore, we stand ready to create as many euros as it takes to rescue all the countries who might be affected. That really changed the dynamic of the crisis.